Hey guys, welcome back to the channel. Today we're going to take investing and take it back down to the very basics of where to start, how to get started, what investing actually is, and why people do it. We'll walk step by step through what you actually need to know to start investing and where to find extra information. If you're new to the channel, be sure to subscribe. Please keep in mind that I'm not a financial advisor. I'm just a normal person that has learned how to invest on my own. Hopefully by me sharing this will give you some tools and resources for you to start investing on your own. It is a little bit complicated getting started, but it isn't rocket science and anyone can learn how to do it. One of my friends said something funny to me after college that made me realize that it's not super apparent why people actually invest. She thought that investing was just for old bald dudes who wanted extra money to go on vacation or buy a yacht or something like that. And that is the idea of investing and wealth that is portrayed in movies, but there are actually three main reasons why people usually invest. Number one is retirement. So the whole idea of investing is that you're putting your money into something. In the case of the stock market, you're buying into stocks or different companies in hopes that the value of those will grow over time. So any money that you put into it will also grow over time. If you know what compound interest is, that's basically the concept of your money being able to earn you more money and more money and more money on top of that. It's very similar to interest that you would earn at a bank, but with investing, it's relying on the value of whatever you're putting your money in going up. With retirement, the idea is that you'll eventually invest enough money that you'll be able to live off of that from when you retire to the end of your life. The earlier that you start investing for retirement, the more time your money will have to compound and the more money you could potentially have once you reach the age of 60 or 65 or whatever retirement age is for you. So to earn extra income, there are a couple of different ways that this can happen. So you can either sell your stocks or your assets for more than you bought them, leaving you with a profit. You could be earning money from dividends, which is like extra bonus money that different companies give you for owning their stock. Or if your account is growing by say 7% a year, in theory you could take out 3 or 4% a year and live off of that or earn extra money from that while you still leave money in your accounts to continue growing. And then there's the idea of storing money. So with a traditional savings account with a bank, when you put your money in there, you're generally going to not be earning that much in interest. Some of the larger banks will only pay you 0.01%. Some banks will pay you around 1%, but it really just depends on the year. From last year until this year, we have seen interest rates fall, which means that that is less money that you're earning for keeping your money in a bank. So sometimes when people have extra money that they know that they don't need for the next 5, 10, 15 years, they'll choose to invest it instead of putting it in a bank account. That way their money has the potential to grow a lot more than it would in just a bank. So what's the benefit of doing that? When the government prints more money and they put more money into circulation, we experience something called inflation, which means that the value of your dollar goes down as time goes on. So to put this in perspective, what $100 would have bought you in 1950 is a lot more than what $100 would buy you today. Inflation rates have averaged around 2% per year, and that can always change. But the idea is that if you can put your money into something that's earning you more than 2%, you'll at least be able to keep up or maybe get a little bit ahead of inflation. So if you left $1,000 in your mattress or in a bank account that earns you 0.01% interest, or you put that same $1,000 into an investment that earns you 7% a year, clearly this one has the potential to earn you more money. So what exactly can you invest your money in? In this video, we're going to focus specifically on the stock market, but it is good to be aware that there are other things if you decide that the stock market just isn't for you. So some people will invest in real estate, some people will invest in precious metals like gold or silver, and some people choose to invest in collectibles, so things like vintage or high-end cars, maybe fancy watches or purses that are known to go up in value, maybe even art Or if you watch Graham Stephan's podcast, they recently had someone that invested in Pokemon cards and now has millions of dollars worth of Pokemon cards. So there are several different options there if you decide to go a different route, but let's look at what you can actually buy within the stock market. To name a few, you can buy individual stocks, mutual funds, index funds, ETFs or exchange traded funds, or you can buy REITs or real estate investment trusts. If you buy a stock, this is like buying a tiny little piece of an individual company. So if you buy a share of Tesla, that means that you own a tiny, tiny piece of Tesla. If you buy a share of Apple, that means that you own a tiny piece of Apple. With mutual funds, index funds, and ETFs, these are big, big groups of a ton of different stocks that people have already pre-selected and put together in this giant group for you. So instead of actually going and buying an individual company, you can buy into this big group of companies and own a little piece of that. I have a couple of other videos breaking this down into more detail, but the main point of what you need to know about these is that this is a super easy way to diversify. When you diversify, that means that you're not putting all of your money into one thing. You're spreading it out a little bit so that it's hopefully a little bit less risky for you if one company starts doing really, really bad. If that's the only company you owned, that would be a lot worse for you than if it was one of like a group of 500 companies that you owned. So we'll come back to that in a minute, but let's also talk about real estate investment trusts. So these are funds that are put together that are basically allowing you to buy into a real estate company. So for example, you could buy into a company that owns the buildings that, FedEx runs in and Office Depot runs in. And there are a bunch of other categories too. So if you just wanted to do a residential REIT, or if you just wanted to do a REIT that owns healthcare buildings, you can go in and specifically search for different REITs for the categories that you might want to invest in. So with all of these options, how do you actually decide what you want to invest in? There are two questions that I think you should ask yourself when you are deciding between these. The first is, how do you handle your money and how attached are you to your money? So are you more logical or are you more emotional when you are dealing with your income? If you're super emotional with your money, maybe you want to consider not taking on as much risk if that is really going to affect you if it doesn't go the way that you want. Or if you are a super logical person, maybe you can justify taking a little bit more risk for a higher reward. Generally speaking, it's considered more risky to invest into individual stocks than it is to invest in index funds, mutual funds, or ETFs. The next question you need to ask yourself is, what type of investor do you want to be and how much time do you actually want to spend on your investments? So how much time do you want to spend researching them and knowing when to buy or sell and keeping up with the companies? So usually individual stocks are going to take more of your time because you will need to look at that company's financials. You'll need to kind of keep up with their news, and you'll just always need to be aware with what is happening with those companies. With mutual funds, index funds, and ETFs, of course, you'll want to research those as well, but overall, those typically take less time to actually keep up with because it is such a giant group of stocks, and a change to one individual stock in that fund is not going to make as big of an impact as if you only owned that one stock itself. So if you do choose to go the individual stock route, there are really two things that you'll be looking at when you're deciding if you want to buy or sell a company. So we have two things called quantitative research and qualitative research. On one hand, we have all of the financials, the numbers, the ratios that you hear about. So like P/E ratio, debt, volume, outstanding shares, that type of thing. And then on the other hand, we have things that could affect that company that don't necessarily have to do with their financials. So it could be whoever is running the company, or if there are a lot of popular trends going around that have to do with that company and information like that. Some people will choose to look at one or the other. So some people will use a very strict technical analysis where they're looking at past patterns of the stock, they're seeing how it could do in the future, and other people will look just at the fundamentals. So really diving into how much that company earns, how much it could potentially earn, and deciding whether or not they think that the price of that stock is overvalued or undervalued. And then there are other people who will choose to buy and sell based almost entirely off of consumer data and current trends. And there are people who are successful at investing both ways. A lot of people will look at a combination of both, and that can be a good idea if you want to get a bigger picture and get a better idea of how the company is functioning as a whole. But where do you actually go to find all of that financial data, find out who their CEO is, and all of that information? Well, if you type in the company and then you type in investor relations on Google, usually this will pull up a page that will let you know all about that company's stock. It'll give you their past financial reports. Usually they'll have their quarterly documents available as well as their annual documents. Keep in mind that because these are on the company's websites, these are documents that they are writing themselves. So they are going to want to make themselves look good. So in addition to looking at those numbers that they release, it can be a good idea to just go and Google around and see what the general feelings are about this stock and see if you can dig up any other information that wasn't mentioned in their reports. If you decide to go the mutual fund, index fund, or exchange traded fund route, the main thing that you'll want to look at with these is their expense ratio. So for being a part of this fund, for owning a tiny piece of this fund, they do charge you a very small fee, but you want to make sure that it is actually a small fee. Vanguard and Fidelity are two brokerages that are known for having low fees for their funds, and many of these fees will be as low as 0.05, 0.03%, so it's not very much at all. Typically, a financial advisor would charge you upwards of 1% of your entire portfolio to actually choose stocks and funds for you, but this way you can do it yourself for a lot cheaper. Okay, so you've decided what you want to invest in, but how do you know where to go to actually invest? So to actually start buying into stocks or funds, you'll need to open up a brokerage account. A brokerage is where you keep your money that you're trying to invest as well as your actual investments. These are going to be companies like Fidelity, TD Ameritrade, M1 Finance, and Vanguard that actually allow you to buy stocks through them. So if you wanted to buy a share of Tesla, you wouldn't call up Elon Musk or the Tesla headquarters and be like, hey man, I want to buy a share of Tesla. You have to go through a brokerage. So brokerages are where you go to actually buy that stock, and they are the ones that are taking care of that transaction to get that stock to you, the customer. But there are a lot of brokerages, so how do you know which one you want to use? There are 6 things that I think you should consider before you actually choose a brokerage to use. The first is fees. There are so many brokerages now that do not charge commission, which is usually an additional charge whenever you buy or sell a stock. Nowadays, there's really no reason to pay that because there are so many brokerages that just don't have a fee for that at all. But if you are going to be venturing into other things like options or Forex or anything of that nature, you do want to check their fees page and make sure that you aren't going to be charged something ridiculous for something that you're going to be doing regularly. Another thing that's important to look at is whether or not they let you do automated investments. So that would basically mean automatically getting money into your account and automatically investing it in whatever you choose. That way you don't have to go back every single week or month or however often you're investing and do that yourself. It's all an automated process. So M1 Finance is one brokerage that does a really good job of making it super easy to automatically invest, and Vanguard is another one that has automated investments into their funds. And that's another thing that you should look for is their funds. Some brokerages will have their own mutual funds that they put together that you can only buy through that brokerage. Some fees will be higher than others, so again, just be sure to check that. The next thing you want to look for is fractional shares. If it's important to you to be able to buy less than 1 share of a stock, then that is something to check because not every brokerage allows that. Fractional shares would allow you, for example, to buy half a share of a stock or a fourth of a share if for whatever reason you did not want to buy 1 entire share of that stock. Usually if a brokerage allows fractional shares, that means that you'll also be able to buy in dollars. So instead of saying I want to buy 1 share of Tesla, you could say, hey, I want to take $10 and I want to put that towards whatever fraction of a Tesla share that gets me. The next thing to look at is app and website usability. So if this is going to be something that you're doing pretty often, it would be a good idea to test out a few different brokerages and see which ones you like best. Some of their apps are really great and some of them are not so great. And of course, if customer service is something that is important to you, that's also something to look into. Some of the newer brokerages don't have live support. You have to do it via email, and some of the bigger brokerages have really good 24/7 support. So I break this all down in a lot more detail in my previous video where I go through all of the popular brokerages. So definitely go and check that out if you're having a hard time deciding which one to use. So that still leaves us with a few other questions. How do you actually make money when you invest? You make money whenever you sell a share of a stock or a fund for greater than what you bought it for. You can also earn money through dividends. This is a little bit of extra money that some companies or some funds will give you for owning a share of their stock, and this is to incentivize you to keep owning it. Not every company or fund offers this, but for the ones that are dividend paying stocks, you can actually make extra money from the dividends that those companies are paying you. The next question is, how long do you invest for? We hear about short-term and long-term investments, but what determines if something is short-term or long-term? And you are the one that is actually determining that. So you can buy or sell a stock really whenever you choose to do so, as long as there aren't restrictions on a certain fund that you're buying. And there are also restrictions about buying and selling a stock multiple times within a certain time frame. But generally speaking, if you decide that you want to buy a Tesla share today and you want to sell it a year from now, you can do that. If you decide that you want to buy a share today and you want to sell it in 20 years, you can do that. But generally speaking, whenever you want, you can go back into your account. You would put in a sell order instead of a buy order, and that is how your stock would actually be sold. So you are the one that is determining whether you want to invest short-term or long-term. And the golden question, can you lose money? Yes, of course. There's always a potential to lose money in the stock market. Stocks do not always just go up. As of when I'm making this, we are currently in a bull market, which means that the stock market has been going up and up in value for quite a few years now. Whenever the stock market is going down, that is called a bear market. And there is never a guarantee of which way the stock market will go. So in the US, yes, the stock market has been doing great over the last decade, but if you look at a different market, for example, Japan, their stock market has not been doing great over the last 10 or 20 years. That's something that's always a potential and something to always be aware of. So how much money do you actually need to start investing? Most brokerages will let you open an account with $0 and they don't have a minimum for how much you have to start with. So if you want to start with a brokerage that allows fractional shares, what you can do is you can literally put in $5 or $10 and go and buy a fractional share of something. That's something that I think is worth it, is to just try it with $5 or $10. See how it works, kind of get used to their interface, see what happens when you actually buy a stock, what the process is that you have to go through, and test it out that way. You don't have to be a millionaire to invest. You don't have to have years of experience or a finance degree. Pretty much anyone can do it. So if this video was helpful at all, be sure to subscribe to the channel, follow us on Instagram, and leave a comment letting me know what you want to see next, and I'll see you guys in the next video.